Hello, financial enthusiasts! Welcome back to Stock Market Catalyst, where we reveal the secrets to financial success in building a solid foundation for a brighter future. Fundamental analysis involves evaluating a company's intrinsic value through the examination of its financial statements, including balance sheets, income statements, and cash flow statements, industry position, management team, and broader economic conditions. It assists us in answering critical concerns such as, is this company financially stable? Is it a competitive advantage? And most importantly, is it a good investment? In this video, we will explore how fundamental analysis utilizes financial statements to assess and evaluate a company's performance. Now, without wasting any more time, let's immerse ourselves in the captivating realm of fundamental analysis. Are you prepared? Let's begin. We'll commence by exploring the balance sheet. Balance sheet is a crucial financial document that compares a company's current assets to its liabilities and owner's equity. Let's define these terms. To begin, assets are goods owned by the corporation, which typically include cash, equipment, and property. Moving on, liabilities represent debts or accounts that require payment. On a balance sheet, liabilities often have corresponding assets that help balance these numbers. For instance, if a company takes out a loan to purchase a property, the loan would be classified as a liability, while the property itself would be considered an asset. The third element of a balance sheet is capital or owner's equity, which indicates the amount of assets obtained through the issuance of stock. For example, when a company goes public with an initial public offering or IPO, or conducts a secondary offering, it raises capital by issuing stocks. The funds acquired can be utilized to cover various business expenses. Balance is attained when the value of assets equals the combined sum of liabilities and owner's equity. The balance sheet provides insights into how a company secures funding for its assets and aids in assessing whether the company is financially overstretched. However, to understand how the company generates profits, we turn to the income statement. This statement illustrates the company's revenues or income and expenses. Expenses encompass the various costs associated with running the business, such as operational expenses, interest payments on loans, and taxes. Subtracting expenses from revenues yields the net income, which signifies the company's profit. Net income represents the profits earned by a company. There are typically two ways to handle these earnings. The first approach involves sharing the earnings with shareholders through dividend payments. The second approach involves reinvesting the earnings back into the company. Reinvesting earnings can bolster a company's cash position, which is crucial for weathering economic fluctuations. That's why some investors emphasize the importance of cash, often referring to it as king. It's also why the cash flow statement holds significant value. The cash flow statement outlines how the company utilizes its cash for day-to-day operations and investments. It provides insights into borrowing activities from banks or bondholders as well. By consolidating these figures, changes in the company's overall cash position are revealed. This statement is vital as it offers a more detailed overview of the company's revenue generation, making it more difficult to manipulate compared to an income statement. As evident, the three financial statements contain a wealth of information. However, analyzing all these facts and figures can be challenging. This is why some investors rely on ratios as a valuable tool. There are numerous ratios available to help investors compare stocks, but we'll focus on one of the most common ones, the price to earnings or P/E ratio. Imagine you have three stocks, one trading at $6 per share, another at $35 per share, and a third at $132 per share. How would you determine which one offers the best value? Some might assume that the $6 stock is the best value simply because it is the cheapest. However, this may not be the case, as the value of a company often depends significantly on its earnings. The P/E ratio allows you to look beyond the stock price and assess which company might offer the best value by considering its earnings. To calculate the P/E ratio, you start by dividing the net income or earnings by the number of outstanding shares, resulting in the earnings per share or EPS. Then, you divide the stock price by the EPS to obtain the P to E ratio. Let's consider the three companies mentioned. The first company trades at $6 per share with an EPS of $0.20, resulting in a P to E ratio of 30. The second company trades at $35 per share with an EPS of $1.40, giving a P to E ratio of 25. Lastly, the third company trades at $132 per share with an EPS of $3.90, resulting in a P to E ratio of 34. Although there are significant differences in stock prices, all three companies have similar valuations based on their P to E ratios. However, the second company has the lowest P to E ratio, indicating it may offer the best value among the three. Keep in mind that the P to E ratio is just one of many ratios available for analysis. There are additional ratios that help assess valuation, profitability, and financial strength. Furthermore, there are other important figures to consider within the financial statements. This concludes our video on fundamental analysis. We've covered the fundamentals of this powerful investment tool, delving into the significance of financial statements, ratios, and key figures. Remember that fundamental analysis allows you to discover a company's underlying value and make informed investment decisions. Yet, this is only the tip of the iceberg. There's so much more to study and explore in the world of finance. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more informative stuff on investing and finance. We're committed to providing you with relevant information to help you improve your financial knowledge. Feel free to leave any questions or comments down below. We love hearing from you and we'll do our best to respond to each one. Thank you for watching and see you on the next video.